You walked into a car showroom. You sat down. Someone smiled at you. They ran your details, came back with a monthly payment, and it seemed reasonable enough. You signed the paperwork. You drove away. What happened in that room felt completely ordinary. But behind that monthly payment, behind that interest rate you assumed was standard, something else was happening. The person sitting across from you had a secret. They had the power to set your interest rate within a range. And the higher they pushed it, the more money they personally earned. You paid for their bonus every month for years, and you had absolutely no idea. 12.1 million people in the UK were in that same room. The regulator has now confirmed £9.1 billion in compensation, and the banks are already fighting in court to stop it. To understand why this matters right now, you need to understand the timeline. This scandal did not break last week. It has been building for nearly a decade. The Financial Conduct Authority began investigating commission arrangements in the motor finance industry back in 2017. For 7 years, while millions of people continued signing finance agreements, continued paying interest rates they did not know had been manipulated, the investigation quietly ground on. In January 2024, the FCA paused all complaint handling, froze it entirely, said it needed time to assess the full scale of what had happened. In October 2024, the Court of Appeal ruled that undisclosed commissions were unlawful. In August 2025, the Supreme Court, the highest court in the land, confirmed it. Failures to disclose commission arrangements were unlawful. In March 2026, the FCA announced its full compensation scheme, 12.1 million agreements eligible, average payout of £829. Total cost to lenders, £9.1 billion. It felt finally like resolution. It was not, because 1 week later, the banks went to court to fight it. To understand what you are actually being compensated for, you need to understand what a discretionary commission arrangement actually was. Here is how it worked. When you financed a car, 3 parties were involved. You, the buyer, the dealer acting as a credit broker, and the lender, a bank like Lloyd's, Barclays, or Blackhorse, providing the actual money. The lender paid the dealer a commission for arranging the deal. Standard practice. Brokers get paid. That part is not the problem. The problem was this. Under discretionary commission arrangements, DC, as the dealer had the power to set your interest rate anywhere within a band, say between 4% and 9%, and the higher they set it, the larger their commission. Think about the incentive that creates. The person advising you on your finance, the person presenting themselves as someone helping you, had a direct financial reward for making your loan as expensive as possible, and they never had to disclose it, never had to mention that they had this power, never had to tell you that your rate was not fixed, it was chosen. Only 22% of consumers recall commission being properly explained to them. Read, that means 78% of people, the vast majority, left that showroom having no idea what had just happened to their interest rate. The FCA banned discretionary commission arrangements in 2021, which means they existed legally for at least 14 years before anyone stopped them. Here is what this cost you in actual money. Say you financed a £12,000 car over 4 years. At 5% interest, the rate the dealer could have given you, you pay around £1,270 in total interest. At 8%, the top of the discretionary range, you pay around £2,050. That is £780 extra on one agreement on one car. The average typical payout per claim is £830 up from an anticipated £700 because the compensatory interest rate applied is higher than previously expected at base rate plus 1% with a minimum floor of 3%. Multiply that across 12.1 million agreements across 17 years, and you arrive at £9.1 billion. £9.1 billion quietly extracted from ordinary people in ordinary showrooms on ordinary Tuesday afternoons. There is a certain irony in the fact that the banks now calling this scheme excessive are the same institutions whose commission structures generated those numbers in the first place. The quietly absurd part? The FCA launched a £1 million campaign warning people not to use claims management companies because those companies charge around 30% of any compensation paid. The regulator had to run a separate campaign just to protect people from being overcharged while trying to claim money for being overcharged. The system remained consistent at least, and now the part that is happening right now, this week. The FCA's compensation scheme is facing 4 separate legal challenges, 3 from lenders, CA Auto Finance, Mercedes-Benz Financial Services, and Volkswagen Financial Services. A 4th from an organization called Consumer Voice, which argues the the payouts are not high enough. The scheme that was supposed to begin processing claims from the 30th of June 2026 yesterday is now likely to be delayed until November at the earliest. In a letter to the Treasury Committee on 9th of June 2026, the FCA confirmed there is still no confirmed court date. The FCA says it will defend the scheme robustly. Martin Lewis, whose money-saving expert site has been covering this since the beginning, said the most important thing is not to let the legal challenges put you off submitting a complaint. Because here is the critical detail. Anyone not contacted by their lender has until 31st August 2027 to make a claim. But those who complain before the implementation period ends are likely to be processed faster. The banks are stalling. The deadline is not. Step back for a moment and look at the full picture. A commission structure that rewarded dealers for overcharging customers ran legally with the full knowledge of regulators for 14 years. It was investigated for 7 years before any compensation was announced. The compensation scheme was then legally challenged within days of being confirmed. And the people who were overcharged are now being warned to watch out for scammers who will try to charge them 30% to access money they are already owed for free. At every stage, the ordinary person navigating this system has needed to know more, do more, and fight harder than should reasonably be required. The FCA says the scheme will put £7.5 billion back in people's pockets, with millions of claims settled in 2026 and the vast majority by end of 2027. That may still happen, but here is the question worth sitting with. A system this widespread, affecting 12.1 million agreements running across 17 years through regulated institutions, overseen by a regulator, did not happen by accident. So the real question is not whether you will get your £829 back. The real question is, what other arrangements in what other industries are operating right now with the same structure, the same incentives, and the same silence that we simply have not caught yet?